환경 글로벌 마켓을 사랑해 주시는 우리 애청자 여러분 반갑습니다. 요즘 시장이 굉장히 어렵고 복잡하죠. 미국 경제도 왔다 갔다 하니까 아마 더 그런 것 같습니다. 네드 데이비스의 알레한드로 그랜달 이코노미스트를 줌 인터뷰를 통해서 만나서 여러 가지 궁금한 점들에 대해서 물어봤습니다. 자, 여러분들과 함께 하겠습니다. Would you introduce yourself a little bit to our viewers?
My name is Alejandra Grindal. I am the chief economist at Ned Davis Research.
This is my first question. Do you think inflation has peaked? And how do you expect the July CPI coming out next week?
It's quite possible that the 40-year high we saw in CPI in that June number may have marked the peak. So energy prices came down in July, so that number should look better compared to June. And I think one important thing to keep in mind is that about a third of that annual CPI growth we saw in June was strictly due to energy. But there's more. So if you exclude energy and food, the core CPI, it actually peaked back in March and has been edging lower since then. We got some good news this week with the ISM and PMI price indexes. Those have also carved out peak. And then we've also seen quite a bit of good news on the supply chain front. So if you look at a lot of measures of global supply chain pressures, they've shown quite a bit of easing, in fact, since late last year. And that tends to, we think that inflection point of lower CPI should be hitting right around now.
And energy prices are falling. However, shelter, wages, and car prices are still rising. How fast will inflation fall?
So that's the bad news, right? Is even though that year to year inflation rate may have peaked, so hopefully that'll be the case, we do anticipate that inflation will stay higher for longer and remain above the Fed's target by the end of this year. A lot of the easing in inflation we've been seeing is just demand driven, changes in preferences, but there's not a lot we can do to address a lot of these global supply shocks that have impacted food and energy prices caused by the Russia-Ukraine war. And then, as you mentioned, the US labor force has had some trouble getting back to pre-COVID levels, and that's contributing to labor shortages and may lead to higher wages in the near term. And then the shelter aspect, I think, is also very important to point out because the United States is sort of unique because a very large portion of its CPI is represented in the shelter component, about 40% of the core or about a third of the overall. And so even though we've seen housing sort of show some easing over the past few months, it tends to manifest itself into the CPI with a lag. So that means a lot of those, that hot housing market we saw late last year, early this year, will continue to work its way into the CPI through the end of this year. So still relatively high CPI, despite there probably being a peak soon.
That kind of CPIs will maybe Fed will not gonna accept it, right?
Yeah, I don't think they'll be happy with that, no.
If the Ukrainian war continues this winter into next year, there is an assertion that the energy prices will rise again. What do you think?
So, we don't have an official firm forecast for oil, but I can talk about the supply and demand dynamics because that's ultimately the determinant. So, from a demand perspective, we are seeing some strong signs that global growth is slowing. So that should ease demand somewhat, but ultimately demand for energy is fairly inelastic. So, in economic term, it's just, not very substitutable. So that means a lot of the near-term outlook hinges a lot on the supply side. So we got an announcement recently from OPEC that they're modestly increasing
little bit.
supply, just a teeny tiny bit, not a huge change on the margin, but anything helps, right? In the US, I think Europe has much bigger issues, especially from the natural gas perspective, because Russia is likely to use it as a negotiating tool. In the US, we're much more energy independent. And yeah, we've seen crude prices have sort of fallen from their peak. Crack spreads have narrowed too. But we don't expect oil prices to decline all that much because refiners aren't incentivized to increase capacity too much because it'll hurt their margins.
Is there any chance of agricultural inflation this fall?
that's another sort of in line with what we've seen with the energy prices. If you just look at aggregate global food prices, they have been edging lower over the past few months. So that's obviously good news. But you're right. I mean, if there's another rise in geopolitical risk, that can clearly have some pretty negative consequences on the food side. But it's also important to note that food is also very susceptible to adverse weather conditions. And with climate change, we're seeing more of these, adverse weather conditions happen more often. And unfortunately, higher food prices, especially like the ones we've been seeing, have a greater impact on emerging and frontier economies because a larger share of their incomes goes toward these basic needs, such as food. So this could contribute to rising misery, as well as even potential for social unrest.
How do you assess Jerome Powell's remarks on the FOMC last week? He said it likely become appropriate to slow the pace of increases. And did he make a mistake, let the market party, or the market misunderstood him?
To be honest with you, I think the Fed has stressed front loading for some time. In other words, big hikes first for greater impact because inflation's high, very, very high above target. The job market's still strong, followed by gradually smaller hikes. So if anything, I think this sort of goes with the plan. Maybe the market was happy just to get the confirmation of it.
Okay. And market just accept what they want to see, right? Just they want to see.
Exactly.
Okay.
And when do you expect the Fed to pivot? Is it too fast for the market to dream of pivoting this year?
I personally think it's too early to come to that conclusion. In fact, one interesting takeaway I got from Powell's press conference, in my opinion, humble opinion, when a reporter asked him about making a policy mistake, of course, Powell responded by saying, we don't intend to do that. So obviously that's not the intention. But Powell did say that if you do too little to stem inflation, there could actually be more pain down the road. So if anything, this indicates to me that the Fed will be more inclined to go on a too hawkish path versus a less hawkish one. So I think the pivot's unlikely this year.
Oh, this year. You mean in December, they're going to raise again in December?
That's our base case for right now. Again, it's very data dependent, but that is our base case, yes.
For the path of their hikes, Chairman Powell's remarks at the Jackson Hole next month seem very important. The basis for Powell's judgment will be inflation and labor market data. And will inflation be a convincing and clear drop by then? There is a two data will come out.
Yeah, I just don't think it's enough time. We saw, that 40-year high in June, right? So at that point, we'll just have one extra month's worth of data to tell us whether it peaked or not. And I think one thing we've learned over the past few months is we've been whipsawed. In other words, we've thought we've seen a peak and then it goes down and then it goes back up again.
Right.
So I don't think Powell would hang his hat and nor the committee on just one reading. And again, that assumes we see some moderation, right? It is what we expect, but you never know. And then even Chicago Fed President Evans, he recently said, I think it was this week, that we're at least a couple of reports away until we've seen inflation ease. So I think it'll still be too soon.
Okay. The number of claims for the unemployment benefits is increasing and job opening is decreasing. The labor market is getting a little cooler, but at this speed, would the Fed like it, or should it cool faster?
Yeah, I mean, it's moving in the right direction, right? The indicators have cooled. We got jobless claims out this morning, so they're hovering around their highest level since November. You mentioned the job openings, so from the JOLT survey, so that fell to a 9-month low. And but I think one thing to point out is they're still at levels that remain consistent with very tight historically labor markets. But as I said, things are moving in the right direction. And usually when we see that peak in job hirings, that tends to correspond to a peak in wages and wage growth, not actual wages itself, but wage growth. One interesting result from the JOLT survey, though, so this is that job openings and labor turnover, is that even though hirings have come down, layoffs continue to hover close to a record low. And that's kind of the ideal situation that the Fed is looking for, right? They want people to keep their jobs, but they just want to eliminate those excess jobs that are out there. I think the worry, though, is things are moving in the right direction, but it does take some time for Fed policy to work. It tends to happen with a lag, so we really, won't know its true impact until a few more months.
A little more months, you mean?
Yeah, several, exactly.
We could see that data in this year?
I mean, you could even argue that we're starting to see some impact now, but the full impact, just because the hikes are so big, may take a little bit of time, maybe 6 months, maybe 12 months. That's sort of the downside of monetary policy is on the plus, it can be done on command and fairly quickly, but its impact can be delayed and it's not always the most targeted. But sometimes it's all we can do.
Okay, thank you. Financial conditions eased as the market rallied and after the FMC. Bill Dudley said the Fed hated. And some argued that the Fed will become hawkish when the S&P 500 rises above 4,000. You were thinking?
I don't know if the Fed would hate it, but to your point, I think it does enhance that argument that they can continue along, this hawkish tightening path. Partly because it tends to correspond with more favorable financial conditions, right? But ultimately, the Fed looks at other measures of the economy. Looking at the job market will be very, very important. So, the direction that goes will probably have a greater pull. And even looking at other assets. I mean, we need to keep a close eye on housing. Compared to the stock market, it has a much greater impact on just the average US household's wealth and spending patterns.
Powell said last hike brought policy rate to neutral, but Larry Summers said Powell's call on neutral rate indefensible. Who do you agree with? And how do you see the level of neutral rate?
Oh, yeah. I mean, as a market economist, right, you have to recognize that official neutral rate because it's what the Fed has specified and will base policy off of it, right? But as we all know, it's sort of an estimate of unknowns. So you can make a really good argument that it should be significantly higher because inflation is extremely elevated and well above the 2% target. So that's what Larry Summers has stressed. At the same time, you could actually make the argument that it's just right, because if you look at long-term inflation expectations, they're actually pretty close to that. When you look at them in aggregate, they're pretty close to that 2% mark and remain fairly anchored. So a lot of it is on perspective, but in practice, you have to go with what the Fed said.
Okay. The consensus is the Fed will stop raising after 50 bips in September and 25 bips in November and December. However, some claim that September will be the last hike in this cycle of tightening. There are others who assert the policy rate should be raised to over 4% to tame furious inflations. What's yours?
So our base case right now is we're looking at a Fed funds rate range of 3.5% to 3.75% by year end. So this is higher than that consensus that you mentioned, about 25 basis points higher. It is below that 4%, but it's not really off the table. It's obviously dependent on what kind of data we get. And the Fed, I don't think knows either. I mean, they effectively dropped their forward guidance and are going to base decisions based on incoming data. But based on some of the clues we see about preferring to be more hawkish versus less hawkish and how much more we have to go to get inflation lower, I think the market or consensus view on rate hikes is probably a little too low.
How about your final rates expectation?
The what rate?
Final rate.
Oh, final rate. So again, it's data dependent. We could see about 2 more rate hikes in 2023. So that would take us above that 4% mark.
Okay, thank you. How will the midterm elections affect the Fed decision?
I don't really think it should a whole lot. I mean, it's not like the Fed is in the middle of starting a cycle right during the midterm elections. It already started it, right? And it's going through a process. And, technically the Fed is apolitical and it has an inflation and growth mandate, which should have nothing to do with the midterm elections. The market, however, may like it. So, so our analysis of midterm elections, going back historically, well, anyone's analysis actually is the president's party usually does lose a chamber of Congress, right? And this typically means less change, less uncertainty, more gridlock. And historically, we have found that markets prefer that. They don't like change. So that could be a good market driver. And then in a secondary way, that could feed itself into Fed policy. But no, I don't think it'll impact their decision directly.
Okay, thank you. Worries about the recessions are growing. And what is the probability of a recession in the next 6 months and 12 months? And why do you think that way?
There are a lot of folks that think we're in recession right now, right? I mean, we got 2 negative quarters of GDP growth, and often we tend to associate that with the definition of recession. However, in the context of NBER, the National Bureau of Economic Research, this is, they're the official arbiters of recession. Just looking at, their definition of a broad-based slowdown, I don't think we're in it right now. And one thing is they've specifically put a lot of weight on employment as well as real personal income growth minus transfers. And both of those elements are still doing pretty well. And then, we look a lot at, we have recession watch reports. We look at a lot of data, and the weight of the evidence tells us that, again, we're not in recession now, but we do think the case is building, especially in the context of rapid Fed tightening. I mean, if anything, we're just going to get tighter and tighter. So more importantly, a lot of the data that we look at that's had a good track record in identifying US recession, and this includes a lot of our proprietary models, they've actually carved out peaks. And our analysis of lead times tells us we could see US recession starting sometime at the end of this year or early next year. So bottom line, even though we may not be in recession now, and a lot of people think we are, it could very likely come soon.
You mentioned the PMI. Yesterday, a surprise rebound in July PMI helped the investors shake off worries that the US has fallen into a recession. How likely do you think the US economy to avoid a recession?
Yeah, that ISM data was fantastic, right? It was surprising. However, it was not confirmed by the market PMI data, the services PMI, that actually went deeper in negative territory. Yeah. So, it's a bit of a mix. Again, it's a promising sign, something worth watching. I wouldn't completely hang my hat on it, but at the same time, it's obviously a really great data series. And then if oil prices continue to fall, that could also be good for consumer purchasing power. But at least based on the information we have now, I think recession sometime in the near term seems more likely than not.
Okay. If a recession comes, is it likely to be mild and short or severe and deep?
I would suspect it to be relatively mild. In other words, not something of global financial crisis proportions. We don't want that. And part of it is financial conditions are better. The banking system is much better positioned now. If you look at debt service ratios, they're still pretty decent. Housing, as I said, is a very important asset to watch because it impacts households so much. And it is experiencing some softness, and we think it will continue to do so. It's very vulnerable to higher mortgage rates. But unlike the global financial crisis, the vast majority of households have not only locked in fixed rate mortgages, but very low ones. So that should keep debt service reasonably, on the lower part. And then I think another thing to keep in mind too, is if we think about, what would be the cause of this recession if we end up being in one, it's really pandemic driven. It's all these weird things that have been going on over the past couple of years. There is the supply shock side of things that obviously is not helping. But when you think about, what would be the cause of recession, we had an overinflated economy because of too much monetary easing, too much fiscal policy, pent-up demand being unleashed, and now the Fed is coming in and aggressively tightening and could potentially put us into recession territory. So, it seems to be more like a result of the pandemic as opposed to something deeply, financial or debt-ridden problems.
It may not be the question to you, the economist. If the coming recession is mild, do we see the market bottom?
Oh, it's a very good question. So usually it depends on your starting point when you're going back and you're looking at data historically. Usually recessionary bears tend to be bigger, so more around the 30% mark peak to trough. We were more along the lines of a little over 20%. So that would mark this one as being, slightly on the smaller side, right? And then what's also sort of interesting too is, as far as we know historically, we've actually never had a bear market before the recession has started. So if we're right that we're not in recession right now and it starts later this year or early next year, it would be a highly unusual occurrence that we had a bear market before it. So it's sort of a, it's an unusual situation that hasn't really happened. But then, these have been unusual times. So it's possible, but based on historical norms, one would expect a little more downside in equities if we do fall into US recession, even in the mild scenario.
Okay, thank you. The 10-year Treasury yield rose to the 3.5% last month and then fell back to the 2.5% this week. At what level do you think the 10-year bond yield will stabilize at the end of this year?
So we don't have a firm year-end estimate. I mean, talk about moving target, right? I mean, just since the beginning of the year, the yield has gone crazy. We do think that 3.5 that you mentioned did mark the peak. In fact, that's actually pretty normal. Usually the 10-year peaks early on in the Fed tightening cycle. When we talk about our near-term outlook, at least for now, we are looking at a trading range between that 2.5% and 3% mark. We just need to get more data to come up with a definitive picture of where things are headed.
Okay, thank you. The impact of QT has not been seen in financial market yet. If QT doubles from September, will the market impact change? Or when do you think QT to affect the rate market?
Yeah, I mean, we do a lot of historical analysis at NDR, right? And QT, we really only seen it one time before, and that little period historically, it wasn't a positive for global equities in general. But again, it depends how things manifest themselves, but ultimately it's just the equivalent of even more monetary policy tightening. So the Fed has conveniently come up with its own estimates. I think this was the Atlanta Fed, and they said that a QE roll-off of over a 3-year period would be equivalent to about a 25 basis point hike. However, during normal times, during more turbulent times, they look at it as being more of a 75 basis point hike. So it just adds. It doesn't appear to be the largest determinant of tightening, but it adds to already tight policy for sure.
And following the inversion of the 2-year, 10-year yield curve, the 3 months and 10-year yield curve is also about to invert. Actually, this week a little bit inverted, right? Temporarily. And how should we interpret this?
Again, we don't hang our hat on just one indicator, right? We like to see confirmation across the board. But yeah, it's another indicator that one of many that we're looking at that points to possible signs of recession in the future. Those curves can often have a pretty decent lead time, so it may not mean recession now, but in that 6 to 12 month period, I mentioned before. We again at NDR, we like the weight of the evidence. So usually you've tended to be in recession when a firm majority of all the yield curves have inverted, and we're not there yet, but we are starting to get close. So that's one thing that we're watching closely.
Okay. And US dollar remains strong. And how do you expect the dollar to move by end of this year?
We've been dollar bulls for quite some time. From a short-term technical perspective, you could make the argument that the dollar is overbought. So we could see some temporary weakness there. But if you look at the long-term macroeconomic argument, it still holds. So whenever we've been in global slowdowns, and we've actually been in one officially, at least according to our estimate since the beginning of the year, sustained global slowdown, that tends to point to dollar strength. If the US falls into recession, that dollar strength tends to last even longer. And then there's also other macro factors. So if you look at the unwinding of monetary and fiscal support, it's happening everywhere, because keep in mind, the dollar is a relative call, right? However, it is, we have indexes that aggregate monetary and fiscal policy together, and the unwinding in the US is significantly more than the rest of the world. It's just happening so much more quickly. So again, that argues for dollar strength. And then even from the current account or trade balance perspective, in the United States, our trade balance is actually, our deficit anyway is actually narrowing. However, in Europe and Japan, due in part to lack of energy independence, their trade situations are actually worsening. And, again, that relative story would argue for more dollar strength.
Thank you. See you next time.
Bye. Take care.
Bye. Have a good one.